I like that comment that we have to embrace it and not necessarily fight it. So what you are saying is that we have to accept what it is.
Yes.
And instead of waiting for a correction to happen, we have to understand that how do we deal with this hype, which basically is a portfolio allocation.
Absolutely.
You basically try to include bond in your portfolio and things like that. So I also want to understand from you, Kalpen, that there are different kind of narratives that are emerging, right? And this entire narrative about a US Fed rate cut and the thinking that this will get more money into Indian equities. But now there's also a great Wall Street Journal article which basically said the US is kind of sitting on a debt bomb which can basically explode at any time. Are we being very naive somewhere in our thinking that because of the Fed rate cut, there'll be another benign kind of environment where money will start flowing in? What are we missing in the entire equation?
So most often narratives are formed by our recent experiences in the last few years, and in the last few years, this narrative has made money that if rates are low, more money flows into emerging markets. There is a higher, demand for growth assets and stocks. And it actually helps them in their prices, and anyone who has believed in this narrative has actually been a beneficiary, and then there is a positive feedback loop. Anyone who took the opposite narrative that all of these low rates are fueling a larger debt buildup in US, they have not made that much money, but that is also a fact. So both are truths. It's not binary, right? It is a fact that if interest rates come down globally, a lot of global capital may say that let us embrace more risk right now and hence go far and invest in other emerging markets wherever there's logical sense. So in some sense, in phase one, some flows can come in. Till the time US is able to manage their debt bomb, which so far they've been able to manage it, how long, who knows? And I am no expert to really think about it. It may continue till it stops continuing, and when it stops continuing, the narratives will change. So narratives will always have phases and cycles. And in that construct, many times, so we keep thinking that what could be next Fed action. There are a lot of articles and comments recently that every time there was a 50 basis point rate cut in the past, in the next year or two there is a sharp 20% correction. But actually these are random correlations. These are spurious correlations. They are not causations that because there was a rate cut there was a correction. Incidentally, in markets, every 2 years there is a 20% correction, rate cut or no rate cut.
Yeah.
So actually, when you look through some of these things, jo hona hai wo hota hai. So again, how do you respond to it is what you can do. Number two, like the start of this rate cut cycle is also signaling that there could be a slowdown in the world. And if the world slows down, one narrative you will hear for those who want to promote equities in India, the narrative will be India is a shining spot, more money will come, equities will do well. Other equally correct narrative would be that if the world slows down, India is not operating in isolation. 45% of our profits come from exporting to other countries. So if there is a slowdown in the world, there obviously could be challenges. If there is a slowdown in the world, China can come and dump its overcapacity in different industries, which can again hurt Indian manufacturers. So there are many divergent points at all points in time. Some will have positive impact, some will have negative, some will cancel each other, some will play dominantly. Personally, after all of these years, I have narrowed down my thinking to just saying that when there are so many narratives and some of them are really pertinent also, you can't price them into an actionable inference. The only thing which are really useful from an actionable inference as a very long-term investor, and which is what we all are as fund managers or money managers, is that what is our job? Our job is to buy future cash flows at reasonable prices. So we have to keep looking at it, where are these future cash flows available at reasonable prices. So in India, many stocks are expensive, but banking stocks are cheap. Increase exposure there. In the rest of the world, many stocks are expensive, but few companies within that are growing still at 25% profitability and having very high ROEs, and that valuation premium is justified. Be with them, don't worry. At the same time, there are many consumer stocks globally which have corrected by 40 to 50% in the last 1 year. And so while we are at all-time highs, there are many iconic companies which have lost 40-50% of market cap because they have gone through a slowdown. they are, their markets are discounting bad news very quickly, unlike in India. Maybe that is an opportunity. And we start building portfolios accordingly. And as an investor, we have a choice not to put all our money today. I have a choice to do SIPs. I have a choice to do asset allocation. There are so many tools available. Just to add one dimension of why these are important, boring concepts, but important to know. Between you look back at history, when markets didn't make money, what type of investor made money? If you ask that question, you will get two answers. One, the one who did not be in market, he made money because he was not in market. But then when market started making money, he lost out. So you can be one of them. You can be happy for a few years, but you'll be sad maybe later, unless you can really time very well. The second type of investor who remained in market and still didn't lose money or made enough money was also an SIP investor. 2008 to 13, market returns were zero. SIP investor made 7.5% return per annum. In the same period, an asset allocation fund investor made around 8.5-9% return, because the portfolio was a mix of gold and bonds. So when stocks fell, gold and bonds actually rose in that period. So there are different templates, and hence coming back, I feel obviously the world will at some point in time recognize that rate of growth is not as high as what markets are demanding or will be demanding. And some bit of consolidation should happen, whether in the rest of the world or in this part of our world.